and so not much to take away on the equity front. Bigger moves happening in the forex market though. The British pound striking a 2-year high against the euro ahead of the election this coming week. Also making gains above 131 against the dollar. The dollar for its part was mostly pretty weak, and actually some of the biggest losses we've seen in the dollar for a while, that was off the back of some soft manufacturing data and employment data midweek. And from the commodities markets, gold, it's pushing into a 1-month high, but it was consolidating there. And at the time of filming, it's still in that region, awaiting the NFP release. And oil, obviously a bit of volatility injected because of that OPEC meeting. Now we'll move on and have a look at what's in the economic calendar, and then I'll discuss those main points, the election and the 2 central bank decisions. So Japanese growth up front, it's expected to pretty much hit a standstill in Q3, and I think that goes a long way to explain the big government spending package that Japan announced last week. We're expecting a slight pickup in German economic sentiment according to that ZEW report. Nonetheless, the data out of Germany and even the PMIs in terms of service and manufacturing activity have remained pretty sluggish. So this will be a rare bright spot for Germany at the moment. US inflation expected at 2%. That pretty much underlines the need for no action from the Fed later on that day, and we'll talk about the Fed shortly. And equally, we've got the UK election and the ECB meeting to discuss more momentarily. So as I mentioned, leading into this British-UK election, we are seeing 2-year highs in the British pound. So that would suggest some optimism about the result and what it means for the UK economy. At the moment, all the polls lead towards a considerable conservative majority, Boris Johnson remaining Prime Minister. And I think the general takeaway is very broadly is that it offers a little bit of a reduction in uncertainty to Brexit. At least we have a deal struck, a withdrawal agreement. So the first part of the two-part process of Brexit, if you like, is done. And secondly, we avoid what is generally thought to be a fairly anti-business Labour Party. No, you can obviously disagree to how much that is the extent, but obviously there are some policies that would come into place, including nationalisation, which are generally thought of to be a negative thing, at least from an investor standpoint, if you're investing in maybe these utility shares or related industries. I think from a global standpoint, this election actually does have some relevance. It's not just about the UK and the British pound. There's actually a pretty stark choice on offer here. Oftentimes you get 2 middle ground parties and there's not much to distinguish between the two. It's almost 2 arms of the same body. You're not getting much choice in the election. This time you are. It's quite stark. It's a choice that really you could say on the extremes. It's capitalism versus communism versus socialism. So if we were to get a shock Labour victory, I think it could reverberate around other global markets. The UK is still the 5th largest economy in the world. London is a very important trading hub. So were the country to go down a different route, seemingly turning away from capitalism, I think that would be seen of as quite a risk-off event, not just in the UK, but globally. Still, that doesn't seem like the most likely result. And our default expectation is that Boris gets a working majority, able to get his deal through by the end of January. And then we just enter the next phase of uncertainty. So all that put together, we can see sterling getting up to 140 against the dollar. And then any gains from there on in, or losses, of course, would be more dollar related and what the Fed get up to. Now, moving on to that with a nice segue, the Fed. We're not expecting any interest rate moves from them. We, LCG, we think probably the Fed's on hold for this meeting and quite possibly the next 2 meetings, basically waiting to see how the previous rate cuts take hold in the economy. As we've just mentioned, there was some fairly soft data out of late in the US. And so even though inflation is expected to hold at 2%, there's probably not much impetus for suggesting that any kind of rate hikes or rate cuts are needed for the time being. We don't need to fend off inflation, but the data isn't so bad that you need to cut rates again just yet. So it's going to be mostly about the economic projections that come along with this report, and the kind of moves that we've seen in the dollar to me would suggest that actually investors starting to think that probably the Fed is leaning a bit more dovish, meaning, okay, they're not making any changes right now, but in those projections, they might lean towards further cuts next year rather than a resumption of the rate hikes. And that makes sense from the prospect that other global central banks are reacting to low growth with further monetary easing, and the Fed doesn't want to completely go against the flow, and economic growth is looking a bit sluggish at the moment. So until we see that anticipated pickup in economic growth next year, rates are probably going to be skewed to the downside. So we're looking at maybe 6 months or more until a rate hike is even possible in the US. If that's the case, it's a dollar bearish event, and we could see some further gains, obviously in euro dollar, pound dollar, and maybe some bigger losses in dollar yen. Last but not least, let's just talk about the ECB quickly. Again, they're expected to remain on hold because there's if you remember, a strategic review that was put in place by the new ECB president, which is Christine Lagarde. So that should be concluded, I would imagine, in Q1 of 2020. So again, it's more about her first press conference and the way she emphasizes different topics. Obviously, she'll be asked to comment in some way about the existing policies in place. Obviously, the ECB is now buying assets again, but there is some, lack of unity within the ranks of ECB members. There's a bit of discord. There are some members that don't really think that extra QE is necessary and potentially even damaging. So she needs to bring about some unity in the ranks, but it won't be so easy to tell at this stage how exactly she plans on doing that. And she has been talking about fiscal stimulus, so it's something we're wondering about, is maybe if she can't keep the unity, if those hawks in the ECB win out, then actually maybe we see this QE policy end quite quickly and a bigger push for governments to take their fair share of the burden with fiscal stimulus rather than monetary. Fiscal stimulus would be good for the European economy, that would be good for the euro, and obviously it would take the place of monetary policy, which is printing euros, which devalues the euro, which is negative. So two kind of positives there for the euro potentially leading into 2020. But let's see what Christine Lagarde has to say. Right, that's it for this week. Thank you very much for watching, and if you do enjoy these videos, please make sure to follow LCG and myself on YouTube and social media.